Hello, I'm Jason Petersen, Head of Advice and Managing Partner at Five Financial, and I'm here with the Chief Economist and Chair of the Investment Committee, David Bassanese from Betashares.
Great to be with you, Jason.
David, it's been a very interesting quarter, quite a positive quarter actually. The SMA, the models have done exceptionally well. I guess a couple of questions off the back of that is, can you just talk through the balanced SMA, which is the broader one, how that's done over the quarter, which is quite staggering. And the next thing off the back of that would be sustainability going forward.
Yeah, so it was a pretty good quarter. I mean, it's one of those cases of markets climb a wall of worry, a lot to worry about. Donald Trump and tariffs, there's sort of various geopolitical risks, both in Europe and the Middle East. But, you know, the MSCI All Country World Index, the global equities returned 8%, 8.2% actually over the period.
That's a quarter.
Yes.
That's quite remarkable.
Australian equities also not too bad, just a little bit behind, up 7%. Growth assets did particularly well. Defensive assets did okay, not as well, but not negative. So we had small positive, plus 1 or 2% returns for fixed rate bonds. And gold in defensive assets also doing pretty well, up another 3%. So overall, the balanced portfolio, which is about 50% growth, 50% defensive, returned 4.3%, ahead of the benchmark at 4.1. So we're happy to take that as a win in terms of outperforming the benchmark over the quarter.
That's interesting. So 4.3% for the quarter. That's effectively about 16-17% annualised, which is well above historical long-term returns. So I guess a really important message there, we can't expect that type of return to persist. But if I look at the outlook and some of the things we're reading at the moment, there's still quite a bit of positivity around global markets, the Australian market to an extent, and particularly if we start looking at defensive and bond markets as well here in Australia.
Yeah, look, I think the key is that Donald Trump, the tariffs have been the big risk factor this year. Donald Trump has gone ahead with lifting tariffs, but they're not as high as they were initially announced in the start of April, the famous Liberation Day tariff increases. They were something like of the order of almost 30% average tariff level for the US. At the moment, the average tariff level has gone from 2.5% at the start of the year to 18%. So it's still a big jump.
Still high.
But importantly, most other countries haven't retaliated. So, Europe, Japan, the rest of Asia, Australia have not jacked up their tariffs in retaliation. Canada have to a degree. China and the US are still sort of at loggerheads in terms of how to go ahead. So they still have reasonably significant tariffs on each other's imports. But they are still talking. But I think markets are sort of growing comfortable with that level of tariffs. And just in terms of the outlook, I mean, the key is that the earnings outlook is still pretty solid globally. So based on current earnings expectations, you're looking at, 15-16% growth in global earnings over the next between now and the end of 2016. So if the valuations of the market stay where they are, that's a 16% return over that period. Now, we'll see what valuations do, but importantly, I think from a valuation perspective, we think bond yields are sideways to down. Our base case is that bond yields aren't going to rise in a major way, so that should at least hold valuations where they are. So if they stay where they are and earnings grow in line with expectations, we can expect more gains from equity markets. Maybe not 8% a quarter, but certainly moving in the right direction.
Okay, so just coming back to that, we spoke about the TACO last time we met, but in terms of the tariffs, what's the main risk that we see if they persist?
So the main risk is what they do to the US economy, and in that again, I think an encouraging aspect and one of the reasons the markets have rallied over the last few months is that there's been not a lot of tariff effect in the US economy. So every month we get the inflation numbers, and the markets have been waiting or fearing a big increase in inflation. It hasn't really happened. Inflation's still simmering along at a level that the Fed wouldn't like, but we're getting like 0.2, 0.3% monthly increases, not like 0.5, 0.6 is what we might have feared from the tariffs. So what it seems to be is that businesses are basically paying the tariff at the moment and not passing on into inflation. Now, one consequence of that is that businesses seem to have gone on a bit of a hiring freeze. So employment growth in the US in the last few months has slowed up. And that is probably a soft spot for the economy at the moment. A lot of other areas of the economy are still going along okay, but certainly employment growth is one new soft part for the US economy. That is a downside risk factor. But having said that, we've also had, again, importantly, the US Federal Reserve signal in a major way that they're likely to cut interest rates at the September policy meeting, which was quite reassuring for markets. And I think the Fed have got the economies back. So if the economy does slow, notwithstanding the fact that inflation is still a bit higher than they would like, they are prepared to cut rates to support the economy.
Let's bring that domestically now, and question from one of our, or many of our clients, but Don last week. Let's talk about the RBA inflation targets and what they're using. We've got the trim in, we've got core, we've got all these different. We're hearing different ways it's explained. Can you just talk about, so when the RBA is talking about their 2 to 3% band, what are they really talking about? And what's the outlook for interest rates here in Australia off the back of that?
Yeah, so the Reserve Bank's inflation target is 2 to 3%. So they want to see inflation, in that area over the long term. Now, their target is the headline CPI. So the headline consumer price index is the official measure of inflation. The only problem with that is it can be volatile, but depending on what things like energy or food and at the moment we've got the governments, both state and federal governments, offering major electricity subsidies. So that's dragged down the headline inflation number. So annual headline inflation at the moment is only 2.1%. Which is at the lower end of the band. So you'd think the RBA should be cutting rates here.
Slash and burn, yeah.
But what they also look at is the underlying measure of inflation, and that's called the trim mean. And what that does is strip out the most volatile price movements in any given quarter, both on the upside and the downside. And it gives you a more reflective underlying measure of what the trend of inflation is. And that's okay, but not as good. So that annual rate for trim mean inflation is 2.7%. It's come down, it's been coming down over the past year. So it is in the band. That's why the RBA was able to resume cutting interest rates in August. And again, the outlook for that is to continue to edge lower into the middle of the target band, around 2.5%, I think, over the next few quarters. And if that happens, the RBA can continue to re-normalise interest rates, as we think. Again, at the moment, the cash rate in Australia, the RBA's official cash rate, is at restrictive levels. It's above normal, and so they can bring it back to normal, which is around about 3% from currently 3.6%. So that'd be the outlook there. You need that inflation, underlying measure of inflation, to edge back into the band and allow the RBA to bring rates back to a more normal level.
So we're pretty positive about that at this stage.
Look, I'm positive on the inflation outlook. We're seeing, again, Australia haven't imposed tariffs on the US economy, so we don't have that inflation shock. We're seeing, goods and services inflation in Australia gradually easing. So again, provided inflation behaves, the RBA can reward the economy by cutting rates.
And that's a good thing from a consumer perspective, and we've spoken previously about consumers driving a lot of the growth going forward. Now that can be really helped along by the RBA cutting rates, obviously for households with mortgages, really positive outlook here.
Yeah, on balance, more households pay interest than collect interest. Obviously, some households out there like high interest rates because they live off the interest income, but there's more households that have a mortgage and are servicing that. So the evidence is lower rates help to boost consumer spending, and the big driver of a recovery in our economy is hoped to be consumer spending. It's been quite weak for a number of years. But as interest rates come down, as inflation comes down, incomes are starting to recover. We are starting to see, the green shoots of recovery, if you like, in terms of consumer spending.
Very positive, very positive. Probably the last thing, David, always got new and innovative products coming out from Betashares, which is fantastic for us as advisors, and looking at innovative ways of just benefiting our clients and how we can structure things more efficiently. Recently brought out the All Growth SMA. Can you just talk to me a little bit about that? Because that feeds really well into our what we call our bucketing strategy that we can use for clients, where we're really focused on making sure that their short-term needs are fixed, their medium-term needs are looked after, and the longer term they can take, if you like, a little bit more risk with the portfolio, because we know we've got a long time horizon for that money. Can you talk about the All Growth portfolio and how that lends itself to our strategy?
Yeah, so all growth, I mean, as the name suggests, is again the typical model portfolio that we have has a balance of defensive assets, cash, bonds, gold, sometimes, and equities, Australian and global equities. All growth has no defensive assets. It's all equities. So it's a blend of Australian and global equities with some of the smart beta allocations in there as well. And it helps in that regard because, you can have a high growth part of your portfolio, almost a set and forget long-term strategy that'll give you the capital growth over the long term. But to the extent you have short-run income needs, you can, as you say, have a bucketing strategy. So you can have a chunk of your portfolio in a more income-orientated portfolio that you can meet your day-to-day needs over the next few years, and then also be comfortable. The thing about the growth portfolios, yes, over the long term give you a great return, but it can be volatile. But you can have that sleep at night, aspect in that you don't have to worry about using that portfolio over the next couple of years because you've got the income that you need bucketed in another portfolio.
So just on that, in terms of the structure of that all growth portfolio, how's that structured in terms of your weightings toward the growth? Some of the smart beta in there, the international, Australian, smart beta, infrastructure, and so on and so forth. What are the key drivers of what determines that?
So the weightings within the growth portfolio are similar to the weightings we use in the other portfolios in the sense that all it is we've just ratcheted it up and given the fact that we don't have any defensive assets in there. So again, something like 60% of the growth portfolio is in international equities. We like that because it gives us good sector diversification in the Australian market. So for all the reasons, we have 60% target allocation to global equities in the existing portfolios. That will also be the case in growth, and also an element of smart beta both for Australian equities and for global equities as well. So things like Australian and global quality, Australian value, and also an equally weighted US index as well, which gives us a bit of a value bias within the US market, particularly at a time where the US market is very top heavy in large cap tech companies. So we think that gives us a good balancing aspect. And then also, Australian momentum figures within the portfolio as well. So the same sort of smart beta allocations you will see within the existing portfolios are also applying within the all growth one as well.
I guess the key takeout from that, from our perspective, is the fact that with those various allocations to the smart beta, so just the global market in itself, the US market in itself, the Australian market and the smart beta, we've got significant diversification. So your risk of your loss of capital, yes, there's going to be times where the portfolio is going to fall, but the actual risk of losing your money if you don't do anything is pretty low, given the sheer volume of companies, individual companies, and only small holdings in each. That's a pretty big part of the portfolio, the model.
Yeah, again, I think it's pretty well diversified from a growth perspective. I mean, again, if the Australian market in and of itself tends to be very top heavy with the banks and the resources, and you see periods where Australian market does well versus global markets and vice versa. So we like to have a foot in each of those camps, and so you're never beholden to, are we in a commodity boom or a tech boom? The sort of things that drive that relative performance. And then you've got the smart beta, which I think each in and of themselves, all of them we think have a good case to outperform over the long run. They do outperform at different stages of the cycle, so blending them all together also dampens the volatility of that exposure within the portfolio.
Brilliant. I think it'd be good to maybe we do a session next time around a bit about smart beta. Would be really good.
Sure.
To explain that. Which next time will be probably toward Christmas, David. I think next time we get together and the committee meets toward Christmas, that'd be fantastic. So look forward to seeing you again then.
No worries.
Once again, very, very good to talk.
Great to be with you.
Thanks, David. Cheers.